Okay, welcome to chapter 50. We've got one more chapter to go before we're done. This is one of those chapters at the end. In fact, most of these chapters at the end, kind of catch-alls. They're hitting some points, some of which are pretty important that relate to the law, but also don't neatly fit in some of the broader chapters we talked about, like the business organizational chapters or the contract chapters in Business Law 1. So this one's going to talk about insurance. And of course, that's a huge topic. Insurance, the insurance industry is one of the largest industries in the United States. Insurance companies are among the largest holders of capital in the United States. So it's unsurprising, given their oversized role in the economy, that insurance companies and insurance touch on business law. So let's go through some of the concepts, the terminology, a little bit of the history, of course, because you're dealing with a frustrated amateur historian. So let's start off and define some terms for us. Of course, insurance is all about risk management. One of the really inventions of the modern world is to mitigate the possibility of bad things happening in the future by pooling risk. So what you're trying to do is, in the past, you didn't know, are your crops going to fail this year and we're going to starve, or is the ship going to sink and we're going to drown? Well, if you can have insurance, you have a lower rate of return overall. You don't get to keep all your crops. You take a certain percentage of your crops that we translate into a policy and translate into a premium, and we pay that so that if there is a failure, other people who are in this risk pool, if our crops fail, we get the value of their crops. And this means that we can kind of minimize what happens in risk in the future. So it's all about risk management. And what we're doing is we're transferring the risk of a failure, of a death, of a fire, crop failure, of an accident, of an injury, to a third party who agrees to be responsible for that. Now, the way he can handle it is he knows, say, that there's 1 out of 100 possibilities of a risk arising. He finds 100 other people at a minimum to contribute to a pool by paying a premium. That premium should equal the possible potential risk here. So a lot of this, of course, is calculating risk. The terminology when we use the term underwriter or insurer, we're talking about the insurance company. The insured is the party covered. So in a life insurance, that's generally us. The policy is the contract, because this is a contract that underlies, and so we can go back to some of what we learned in Business Law 1. The premium is that consideration that's passing on one side. That's coming from the insured. Now, of course, the other side is not immediately giving a tangible benefit, but it's giving the assurance of coverage. So there's kind of two types of consideration flowing there. And of course, the agent or the broker is the party who represents the insurance company, the underwriter, or the insurer. Now, you can say, and I usually say, that among the first modern insurance companies, Lloyd's of London, which is not strictly speaking an insurance company. They're regulated by an act of parliament. It's a good deal more complex than that. But for the sake of argument, I think it's very fair to say that, yes, Lloyd's of London is an insurance company, and arguably, functionally, an insurance company, one of the oldest. And this is where it really starts, and it started with ships, where if you had a ship go out and come back, you could make a lot of money. But if your one ship sank, you lost everything. So ship owners, which usually would only have one ship, wanted to pool their risk. They didn't want to lose absolutely everything. They liked getting all the profit from a single one, but they disliked losing everything. So they began to, through Lloyd's, mitigate that risk. So that in a certain sense, you don't own one ship out of the 1,000 ships that sail. You own 1/1000th of every ship in an insurance policy, and you're pooling your risk. Now, actually, the oldest insurance company that's still functioning in the English-speaking world is Sun Insurance Company. This started in 1710, And I believe both of these started in coffee shops. Now, that's we're going to have a little story here, and you'll have to forgive me. But one of the arguments, and it's kind of a interesting argument, is that when coffee is invented, coffee and tea, it dramatically changed the intellectual and economic life of the country, because previously the only thing to drink that was safe, you couldn't drink water in a modern city prior to sanitation, because you could get cholera, you could get all these waterborne diseases. But of course, when you're making coffee, what do? You boil the water. Same with tea. And it wasn't like drinking alcohol, because you could drink that safely, but you have 5 or 6 or 10 pints of alcohol, you're not going to be in the mood to set up a company or maybe foment a revolution. However, if you're sitting in a coffee house and you're getting jazzed up on caffeine and you're not getting sick and dying of cholera, you can think a little bit more long term. So we can all thank coffee and tea to some extent for helping usher in the age of enlightenment, and insurance companies as we know them. All right, so continuing with a few terms here. Risk pooling is what we're doing here. We're creating a risk. We know the risk, we hope. And for things like life insurance policies, we develop actuarial tables. And actuarial tables are predictions of date of death. Now, I believe it's still operational. There is a website called deathclock.com. It's kind of grim, but you can go there. You can put in your gender, your age, your height, your weight, and it will give you, according to the actuarial tables, your projected date of death. Now, obviously, they don't know that you're going to die August 1st, 2084. But what they do know is if you take 1,000,000 people, your age, your date, your weight, your gender, that the deaths will be clustered in that area. So they don't know exactly, but they know within a statistical probability how likely it is for you to die before that date and after that date. And that allows them to calculate how much money they would need to take from you and people like you, so that by, I think I said 2084, by 2084, if you're carrying a $100,000 life insurance policy, they can take just enough from you, with profit of course, just enough from you, invest it, let it grow, and then when you die, pay the $100,000 to your heirs. Of course, the nightmare for them is they miscalculate the risk pool, in which case they don't have the money to pay. Generally, we classify insurance according to the nature of the risk involved. So one of the things that you have to have here is an insurable interest. We want you to have something personal or directly financial that is going to be a loss to you if the item insured or the person insured is injured or dies. So for life insurance, you must have a reasonable, and again it's personal or financial, expectation of loss or benefit. This allows, by the way, companies to take out insurance policies on key individuals. And this is very common in law firms, and, where you will have senior partners will have fairly hefty policies. Now the interesting thing is the company, the law firm, will pay for that policy, and the money from that policy will buy out that partner's interest in the partnership. So if there is, say, $1 million policy on it, when the spouse gets that money, when the husband or the wife of the senior partner gets the money, that means that that partnership now has paid off that interest. Property insurance, generally you have to suffer a pecuniary loss, a monetary loss if an item is destroyed. And we are looking at that when the actual loss occurs, not in the past. So, one of the questions I get about insurable interest is, well, who can you insure? Can you insure your wife or your husband? Sure you can. Can you insure your children? Yes. So what makes them insurable? Well, think about direct loss. And one of the quirks I tend to talk about here is this next slide. Why not insure the president? Between 1820, this is called the curse of the zero. between 1820 and 1960, every president elected in a year that ends in 0 dies in office. Right? So you've got a statistical probability. I think we're up to, the mid 40s in presidents, but if you look there's 8. So let's suppose we've got 50, just to make our math really simple. We've got 50 presidents. I know it's not 50. I know it's in the 40s, 46, I think, 47. But we're going to say 50. That means that there's a 16% probability, if we use these as our guide, of the presidents that died in office: Harrison, Taylor, Lincoln, Garfield, McKinley, Harding, Roosevelt, and Kennedy. If we look at those, there's about a 16% probability. Well, that's a really high probability. So why not take out a life insurance policy on Joe Biden? And I am not wishing Joe Biden ill. I am using this only as a demonstration. Well, the reason you can, if you think about it, is yes, you might be sad, or if you're not a very good person, you might be happy if Joe Biden died, but you are not going to face a direct financial loss. So Joe Biden's wife would, Jill Biden. Arguably, I guess the office of the president could take out a life insurance policy, because I'm going to assume that he's got one. But you wouldn't, so you can't take out a policy. Okay, returning back to the insurance contract. Generally, the first part is an application. So you are going to apply. Now, of course, sometimes there's inaccuracies in a policy application. And if they're important, if they're material, that can affect as to whether the policy is effective. So I'll give you an example. My mother and my sister were both born one day apart in October, obviously different years. So I confuse all the time, was my mother born on the 14th, or was she born on the 15th? Was my sister born on the 14th or the 15th? If I was filling out paperwork for some sort of insurance on my sister and I put the wrong date down by the date but not the year, so I said, okay, my sister was born in, and I'm not going to give you her year because I'm not stupid. If I gave you the year but I put one day off, that's an immaterial mistake. It's not going to affect any application for insurance. But if I put a year, if I was applying for life insurance for my mother, who is in her 90s, and I applied for insurance and I didn't miss the date, but I missed the year, I put my sister's year, so there's a 30+ year difference there at least. Well, that would be material, and that potentially could void the life insurance contract. Now, the date of coverage, there are different options for it to start. So it can be when a binder is written, which is the temporary contract that goes forward, or when the formal policy is issued, and that usually means that the application has been accepted and they've said, oh, right. After a set time, if I don't hear back, we're going to do, or after a set condition. Now, if you're getting it from a broker, you're not going to have a contract. You actually get a physical contract in your hands. If you're obtaining it from an agent of the insurance company, usually when the application is made and they accept the application, you get a binder. So you've got kind of the beginnings of a contract that's enforceable. Now, sometimes there are specific exemptions to that. They might say, we're going to carry your life insurance now as a binder, but it's pending a physical exam to make sure that you don't have a chronic condition. Some of the provisions of contract. Now, again, on page 596 of the 15th edition, let me just change that quickly, of the 15th edition, you can see a list of common provisions and clauses, but many states require specific clauses. And this has been a fight about things like medical insurance. So there are some people that argue you should have an absolute free market. You shouldn't have to have clauses in there that are mandated. Other people say, well, if you don't do that, it's such a complex thing that the people writing them will take advantage. So we've kind of split the difference, where there are some things that are in there, and if they're in there, they mean certain things. So One of the things that's very common is an incontestability clause, which says if you have a contract in place for 2 or 3 years, the insurer can't cancel it even if there is an inaccuracy in application, although you can sometimes limit it going forward. A co-insurance clause. This can be important. This applies for fire insurance and certain other property. This is one that I have to explain to clients at closing sometimes. And it's going to take a little bit of talking about fire insurance, but basically it's very rare that you have a fire that completely destroys a house. So if we play with a very simple number, let's suppose a house is worth $100,000. The typical fire damage would be something like 20%, $20,000. A really bad fire would be something like 50% or $50,000. So when you go to sign up for a policy, very often you think, well, why should I get a full $100,000 policy? You know, if the odds are that I'm only going to suffer 20 and at the worst going to suffer 50, I'll just get a $50,000 policy. Well, the co-insurance clause says no. If you don't cover at least 80% of the value of what you're risking, then we limit what you recover. So if you only took out a $50,000 policy on a $100,000 house and there was a fire, you would not recover, unless there was $20,000 worth of damage, it was a standard fire, you would not recover the $20,000. You'd only recover 10, because 50,000 of 100 is 50%. You didn't get to the 80% threshold, therefore you would only get your coverage rate of 50%. Sometimes there can be appraisal and arbitration clauses. If you disagree about the amount of a loss, you can go to a third party which can impose a solution. If you have multiple insurance coverage, now this isn't for life insurance. I can have a life insurance policy with 10 different companies for $100,000. That's fine. It's not going to affect it. We're talking about something that has a established pecuniary value, like a car. You know, if you bought a new car for $50,000, you couldn't have 5 automobile insurance policies for $50,000 each. The car gets wrecked, and great, now you collect $250,000. Basically, the payout from all of them, and they do talk to each other, cannot exceed the actual value of the car. We also have anti-lapse clauses, which gives you grace periods to cover when there is a premium that's overdue. Interpreting provisions. Now, words are supposed to have their standard meaning, and if there is an ambiguous term in it, it should be interpreted against the drafter, the person who actually wrote the insurance contract. Can you cancel them? Sure. When can you cancel them? Well, big one is you don't pay your policy. Or if there was fraud or material misrepresentation. Conviction of crime can trigger it sometimes, or gross negligence. Each party is required to act in good faith. Good faith underlies much of contract. And there are defenses against any payment, that there was fraud or misrepresentation, obviously, that there was a violation of any warranty or violation of public policy, or what you were doing was illegal. All right, so let's talk about some types of insurance, and we're going to start with life insurance, which is very common. And this was much, much more important prior to the 1930s. The reason it was so important was the largest group of people that were in poverty as a percentage prior to about 1935, 1940 in the United States were old people. Because when people got old, if they hadn't saved money, they were poor. They didn't have Social Security. One of the ways they kind of fought this, and particularly, is they would build up value in life insurance policies. That was nice. But also for their spouse in particular, to prevent a spouse, particularly at this point, it was a rather more misogynistic society, a woman who was staying home doing the homework, which was not being compensated for, the husband would carry life insurance policies, so she wasn't poor if something happened to him. Fast forward, of course, let's talk about some different types here. There's whole life. Now, whole life policies, as you hold them for 10, 20, 30, 40 years, they build up a cash surrender value. So we might say, well, you've had this whole life policy for 30 years, you've been paying X amount of money. Right now, if you surrender it, if you say, okay, I'm done paying it, the life insurance company will give you money. They'll say, okay, we'll give you $10,000. There's limited payment life, which pays premiums for a set number of years, and then you're done paying. So you pay $10 a month for 10 years. At the end of the 10 years, the policy stays in force, but you stop paying premiums. There's term insurance. This is usually the cheapest, where pretty much every year there's a set rate, sometimes every 5 years, sometimes every 10 years. There's a set rate per year. We're still talking life insurance. You pay this money, we cover this much. After 5 years, if you let the policy lapse, you don't get anything. But it's cheaper than the whole life. There's no surrender value to it. It doesn't accrue any value. Very often, key people insurances are term life. It's as cheap as you can get away with. Endowment, where you have a fixed payment for a set number of years, then the policy pays to insure or the beneficiary if the insured is dead. So you pay an endowment for 10 years, 20 years, 30 years. At the end of that, okay, when it ends, now you start collecting money from the insurance, kind of flips it. And I'm going to talk about taxes in 1 second. Universal life is a mix of the term and the whole life, where part of it pays the term, the rest of it gets invested and grows at a variable rate. Now, the issue with a lot of these is there was, particularly in the past, and still today, but not as much, certain tax advantages to them. So if I had a universal or a universal life policy, and let's suppose I paid $100 a month, well, the company may take $30 to buy term insurance, and I've got $70 left over. Well, they'll invest that $70 for me, and it will grow, and it's in my name. But here's the nice thing. It grows tax-free. So I don't pay any taxes on it. And if it grows to $20, $30, $40, $50, $100,000 at the end, yeah, if I take it out, it might be taxable. But while it's sitting in the account, you can also have it buy extra life insurance, which typically is done, or builds up the cash value. Also, the nice thing about universal life is you've got this pool of money sitting there that you are entitled to if you want to take it out. And this is going to sound strange, but you can actually borrow against it. So you go to your insurance company and say, I know I've got $50,000 accrued value in my universal life. They say, yes, you do. I'd like to borrow that money. They'll say, sure, here's a check for $50,000. Just pay it back. Well, who are you paying back? You're paying back yourself. So you are essentially taking out the money. You owe yourself money, and we'll talk about if you can't pay it, but you owe yourself money, but you don't pay tax on it. When does it pay? Well, generally, any cause of death is covered. Now, there are certain exceptions. Suicide in the beginning. After a few years, suicide is actually covered under many. If you're a passenger in a commercial vehicle like and there can be exemptions to this as well. Military action, if you're in the military, they have to have special policies. Or if you are executed, not covered. Alright, now life insurance continuing. Let's keep talking about this before we get to fire. It doesn't void the policy if you misstate your age, but it can affect your payout. The assignment, who you're going to pay, like who my beneficiary is. So my beneficiary obviously is my wife Shirley. If something was to happen to her and I got divorced or she died and I remarried and my new wife's name is Jane Doe, then I could change who gets the money. Now, creditors can get certain rights against policies. They often get liens, but they usually cannot compel you to change the beneficiary to them, which they might like to do, although they can ask you to, or compel you to surrender it. All right, let's talk a little bit about fire insurance. And again, there's different types of fire insurance, and I'll refer you to page 967 of the 15th edition there. Basically, one of the things I tell people is be careful with fire and loss insurances, because one of the things is your property has to be occupied. You're probably saying, well, why does that matter? Well, let's suppose you are selling your house, but you've moved out of town. You've moved to Wisconsin because you got a job up there. You're getting ready to start the job. Your house is sitting here empty. There's a fire. Your standard fire insurance policy may not cover it. So you have to be careful. Most of the time you have to show that you occupied the property. Then you show that you suffered a loss, and you show you didn't set it, and you're good then. Generally, you cannot assign who gets the money from these without the insurer's consent, because very often the fire and property and loss insurance is actually going to pay to the mortgage broker, not to you, at least at first. Homeowners insurance. This covers the house, obviously, but also, and here's a term we're going to introduce to you, the curtilage. Curtilage is the area immediately surrounding the home that you routinely use. And it could be something like the patio outside or your swimming pool. It also, interestingly enough, covers your personal possessions while you are traveling, at work or home. It also covers certain living expenses. Now, the liability coverage is any injury that occurs on the insured property, and damage or injury by the insured to others on their property, but not malpractice. So it's pretty broad coverage, and you should check into this sometimes as opposed to getting insurance. All right, here's a big one, automobile insurance. This is something that we all pretty much pay or should pay. So we're going to cover bodily injury, and that's going to be, let's just suppose we've got a single car accident. I'm recording this shortly after Tiger Woods was in a single car accident, ran off the road in California. So it's going to cover the damage to the car. As I understand, the car, which was a rental car, was more than $100,000 value of car. Also, if he had hit someone, it might cover bodily injuries to them, or even sometimes to yourself. So collision covers damage to the insured car after deductible. So the deductible might be, say, $500. If you have more than $500 damage, the collision will cover it. Comprehensive will cover things like, what if the car burns down while it's in a garage? What if it gets inundated by a hurricane or hail or vandalism? One of the common things happening today, and automobile insurance is covering this, is people are stealing catalytic converters off of cars because of the skyrocketing value of some of the rare elements inside these catalytic converters, which now per ounce is worth more than gold for some of the stuff that's in them. People are stealing them. If that happens, your comprehensive insurance would cover it. A big thing that we have to have, sadly, is uninsured motorist. So, if somebody else hits my car, their insurance company pays me if they're at fault. Well, what happens if that person that hits me doesn't have insurance coverage? Well, if I have, and most people will, have uninsured motorist, if I get hit or hit and run by someone and I don't know who they are, or they don't have insurance, my insurance company pays. Now, sometimes some states, now North Carolina doesn't use this, but some states, I believe New York is a big no-fault. This is interesting, where you don't have uninsured motorist because your policy just covers you, period, end story. If you're in an accident and it's the other guy's fault, who cares? You file against your company, not his company. So you don't have to worry about uninsured motorists. Here is a breakdown, and this is one of the more recent slides. I think it's 2015. You notice that North Carolina, about 6.5 or let's say 7% of people driving don't have insurance. But go down to Florida, the famous Florida man, 26%, 27% don't have insurance. I just saw one update on this, that Mississippi zoomed into the lead recently. They're up to 33% have no insurance. So this is why we all have to have uninsured motorist. All right, business liability insurance. generally you have key business insurance, so you want to cover any risk, and you're going to very often draft a contract for any sort of business liability, and it's really going to depend very heavily upon what you're doing. You know, one of the things I'm a little bit more familiar with is professional malpractice. So as a lawyer, increasingly lawyers are sued by clients for malpractice, and many lawyers will carry a malpractice insurance, particularly if you're in a high risk area. Not that you mess up a lot, but if you mess up, there's a clear pecuniary or financial loss. Quick example of that is real estate closings. If you do a lot of real estate closings, you know, you are closing a house that's 500, 600, 700, $1 million house. Well, we want the risk here is that, well, if you screw up, that's a huge liability. So you're going to have to carry malpractice insurance. It's not cheap. Some lawyers practice in some fields where there's not a big requirement for liability insurance, but real property is pretty common. Workers' comp, we're not going to talk too much about because we covered that in chapters 33. We looked at workers' comp. Okay, came in right at about a half an hour. We got one more chapter to go, so when you go into the next one, we will start with chapter 50. I think we're going to talk about trust next time. Till then, see you in the funny papers.